Okay, S&P 500 futures are flat. I mean, we are looking at a pancake here, oscillating in a remarkably tight 5-point range right now. Nasdaq 100 is down a marginal 0.1%. Treasury yields are just pinned at 4.22%.
It's the classic wait-and-see Monday. It really is. The market is basically treading water. We are sitting right in front of tomorrow's ISM manufacturing data and then, Friday's non-farm payrolls.
So nobody wants to be the hero.
Nobody. Institutional volume is completely sidelined until we see those numbers. The data deck is just too heavy this week.
And we have that overnight catalyst, or, well, maybe the overhang of it, the Warsh pivot. Kevin Warsh's nomination for Fed chair is really cementing this whole higher for longer narrative, isn't it?
It absolutely defines the immediate context. We are deep in the belly of Q4 earnings season. And look, the AI honeymoon of the last couple of years is colliding with the reality of just massive capital expenditure. So investors are now hunting for margin expansion, not just those big revenue beats. You drop a Fed chair nominee like Warsh into that mix, and, well, the cost of capital isn't coming down. That changes the entire calculus.
Let's unpack that for a second, the Warsh pivot, because it feels like the invisible hand moving everything today.
Yeah.
Why so defensive on just a nomination?
Because it's a regime change. See, for the last, 15 years, we've operated under the assumption of the Fed put.
The idea that the Fed would step in and save the market if it fell hard enough.
Exactly. Warsh represents a return to sound money principles. He is not a dove. His philosophy is that the Fed is not the backstop for asset bubbles.
So he's taking away the safety net.
He removes the psychological safety net. And when you do that, volatility just naturally increases. That's why you're seeing this tentative wait-and-see tape. Big money doesn't want to be exposed to high-valuation tech if the central bank isn't guaranteeing the system.
So what are we pricing in now for cuts?
Markets are now pricing in only 2 rate cuts for the entire year for 2026.
Only 2. That is a massive, massive repricing from, just a few months ago.
Massive. And that brings us right back to that 10-year yield. It eased off the 4.26% peak, sure, but the floor has moved up. This 4.2% level, it acts as a gravity well for these high multiple AI stocks. It just compresses the PE ratios.
Okay, that's the perfect segue into the movers, because even with the indices flat, the stock-specific risk is incredibly high. Let's start with the general. NVIDIA, ticker NVDA, up 1.4% pre-market.
NVDA is still the global liquidity proxy. It almost doesn't matter if the S&P is flat. If capital is moving, it's moving into NVDA first.
And the catalyst is a rumor, right? A massive sovereign wealth deal in the Middle East around the Rubin architecture.
This is significant. Rubin is the architecture after Blackwell. It's the next generation. The fact that we're hearing about sovereign wealth funds circling it, that signals the next phase of AI spend. National AI.
So we're not just talking about hyperscalers like Microsoft and Meta buying chips anymore.
No. We are talking about nation-states. Countries securing compute sovereignty. That is a price-inelastic buyer. A government worried about national security, they don't care if the gross margin is 70 or 80%, they just need the hardware.
So for the trader watching the screen, that brings us to the levels. Bull case needs to break 1320.
1320? That's the trigger. It signals the next leg up for the whole semi-complex. If we clear that, this consolidation is over. But, and this is critical, the bear case is a failure at 1265.
And why 1265 specifically?
If buyers don't show up there, sentiment flips negative. It means the buy the dip crowd is exhausted. You have to watch the tape at that level. If it gets heavy, the broad market will feel it. NVIDIA is just too big to fall alone.
All right, moving to the other side of the ledger, we have Tesla. Ticker TSLA, down about 2.8%. Q1 delivery guidance out of Berlin is soft. They're citing logistical friction in the Red Sea.
Yeah, this is where macro hits micro. The Red Sea issues aren't new, but the persistence of them is causing real supply chain drag. It's not just shipping costs, it's about component timing. You can't get the parts, you can't build the cars. Simple as that.
And the technical damage here looks real. The stock is testing its 200-day moving average right now.
That 200-day, that's a big line in the sand for a lot of institutional algos. It's the dividing line between a correction and a real bear market for a stock.
So if it's above the 200-day, it's investable on dips.
Generally, yeah. If it's below, it's considered broken. If Tesla loses that 200-day, you invite the momentum shorts. The whole narrative shifts from buy the dip to structurally broken. It's a dangerous spot.
Let's pivot to where the volume actually is, because there's a clear rotation happening.
Sure.
CrowdStrike in the cyber sector, CRWD, CIBR, HACF. The volume on CrowdStrike is 2.5 times its 30-day average.
The why is obvious. We had reports over the weekend of a pretty significant breach at a Tier 1 European financial hub.
And this triggers what you call the budget lock phenomenon.
Yeah, right. Budget lock. Think like a CFO. In this environment, you might cut an experimental AI project. You might delay an office renovation. You cannot cut security, especially not after a major bank gets hit.
It scares the boardroom.
Exactly. It unlocks capital that flows immediately into mandatory spend tech. Companies like CrowdStrike. It's a defensive move disguised as a tech trade.
So looking at the tape, CRWD needs to clear 512.50.
That's the breakout level. 512.50 on volume, we could see a run to all-time highs. But you have to watch the downside. 488 is the 20-day EMA. If it fails there, this was just a pop.
Okay, and then there's Palantir, PLTR. Catalyst is a new $450 million DoD contract. Decentralized AI surveillance.
This is a fascinating setup. This is where, retail engagement meets institutional accumulation. Palantir has been fighting that meme stock label for years. A contract this size validates the platform at a strategic level.
Decentralized surveillance, what does that actually mean operationally?
It means running AI models on the edge, on drones, on satellites, in the field. Not sending all that data back to a central server. It's the future of modern warfare, and this contract proves the Pentagon is buying into that vision.
So the bull case is a hold above 44.20.
Correct, 44.20. If it holds that, it's flagging for a move higher, but the bear case is a break below 39.50.
That's a pretty wide range.
It is, because Palantir is volatile. But if it cracks 39.50, that's a liquidity trap. It means the breakout failed, buyers are trapped, and it could slide to 36 fast.
Okay, let's zoom out to the indices. S&P 500 futures, the ES. We've failed to break 6,200 3 times now in the last 48 hours. Triple top or coiled spring.
Well, right now, gamma exposure is neutral. And what that means is market makers, the folks providing liquidity, they aren't forced to hedge aggressively.
So they're not forced to buy or sell.
Right. And that leads to this pinning action you're seeing around 6,100. The market just feels sticky. There's no structural force pushing it.
So what's the line in the sand for today?
6085. That's the high volume node from last week. That's where the most business got done. Stay above 6,085, and the bulls still control the narrative.
And if we slip below?
We test the 50-day moving average. Structural support is down at 6,020. If 6,085 fails, expect a fast flush as stops get triggered.
And upside resistance, 61.45.
Sellers are stacked there. We need a catalyst to clear it. Without news, that's a fade the rip zone. You sell into that strength.
Now, the Nasdaq 100, the NQ, it just looks heavier than the ES. Tech exhaustion is visible.
That's that rotation we talked about. Money is flowing out of except for NVIDIA, and into defensive value. The line in the sand for the NQ is 20,950.
29.50.
Below that, the AI growth narrative loses to valuation concerns. If we lose 20,950, the bears have an open field. Resistance is up at 21,320. We've been rejected there 3 times in 10 days.
So momentum is bearish until we reclaim that level on volume.
Absolutely. Until then, you're playing defense on the NQ.
Okay, let's talk about the dollar, the DXY. Spiking to 97.16. That feels aggressive.
It is a strong headwind. People forget this correlation. A stronger dollar just crushes overseas earnings for mega cap tech. Think about Microsoft, Apple, Google. They sell software in Europe. They get paid in euros. When the DXY rips, those euros are worth less dollars.
It's an automatic haircut on earnings. Is there a warning level on the DXY to watch?
97.30. Watch that level. If the DXY breaks above 97.30, expect a midday flush in the Nasdaq. It won't matter how good earnings are. The currency drag forces the algos to sell. It's a mathematical relationship.
All right, let's talk strategy. We've defined the board. Now, how do we play the game? You've labeled the market status a liquidity trap.
We're seeing low volume drift overnight. This is dangerous territory. The market is just baiting retail into breakout trades that will reverse.
How does that trap spring?
Right at the open. You see a green candle, you think, here we go, you buy. But because volume is so thin, institutional algos use your buy order as liquidity to sell their own positions. And then the price reverses hard against you.
So the advice is to avoid buying the initial 15-minute high.
Yes. It's likely a stop run. Wait for the first 30, maybe 45 minutes. Let the amateur hour wash out. See if we hold that 6,085 level on the ES. Then you can look for entries.
So the playbook is mean reversion.
Exactly. Sell rips to resistance, buy dips to support. Play the edges of the range. If you trade in the middle today, you're going to get chopped up.
What's the pain trade today? The scenario that catches the most people off guard.
Pain trade is if the 10-year yield spikes towards 4.31%. If that happens, you get a liquidity vacuum in the AI laggards.
The over-leveraged software names?
The Tier 2, Tier 3 cloud stocks. The company's promising AI growth but with no profits. Retail is buying the dip there, expecting 2024 all over again. But if yields push that high, the discount rate just crushes them.
So cash is a position today.
Cash is absolutely a position. Focus on unit economics, cost of capital, not just AI vibes. This market is discerning. In a Warsh world, promises are expensive. Execution is the only currency that matters.
And we saw that divergence last week, right, between profitable and unprofitable tech.
The divergence is extreme. Look at Microsoft versus Meta. Microsoft stumbled on CapEx concerns, but Meta rallied. Why? Because Meta showed they can monetize the spend immediately with ad revenue. The market is rewarding execution right now.
So, practically speaking, the bell is about to ring. That Palantir setup with the DoD contract, is that a trade at the open?
You have to be careful of the pop and drop. Retail sees the headline, they buy blindly. I'd watch that $44.20 level. If it pumps to 45 and then rejects back down through 44.20, that's a short signal. If it grinds above and holds it as support, then it's a long.
Don't just buy the headline. And NVIDIA.
NVIDIA is different. It's the market general. But again, the level is $3,320. Don't anticipate the breakout. Buy the breakout.
Okay, to wrap this up, mission for the open.
The tape is flat, but the undercurrent is aggressive. It's a flight to quality within tech. Do not chase the indices. Follow the volume into cybersecurity and that sovereign AI theme.
And the one thing to watch above all else.
Keep your eyes glued to NVDA at $1,320. If it breaks, neutral sentiment evaporates, bulls take the wit. If it rejects, stay in cash or defensive cyber.
Market opens in minutes. Stay sharp.
Watch the levels. Let's get to work.